Question: a UK general insurer has a growing exposure to severe weather losses and is considering purchasing catastrophe excess of loss reinsurance. Management notes that risk transfer is expensive and proposes instead to tolerate the risk while holding additional capital. The insurer's customers are in a region where many households have limited ability to pay higher premiums for insurance. Discuss how you would advise the board, explicitly addressing the 4 T's: affordability constraints, capital management, reinsurance design, counterparty risk, and the monitoring feedback loop. You must integrate both prudential and conduct objectives. 25 marks. Section 1. Interpretation and key points. Quick awareness check. The 4 T's, moving from a passive do-nothing to an active selection of tolerate, treat, transfer, or terminate. Affordability versus solvency. Reinsurance costs increase premiums. If customers can't pay, they lose coverage, protection gap, creating conduct risk. Reinsurance design, catastrophe excess of loss, CAT XL, protects the tail but introduces counterparty risk. Capital management, holding more capital is expensive and lowers return on equity, ROE. Section 2. Logic breakdown. 1. Framework selection, the 4 T's. Management's proposal is to tolerate. You must argue that toleration is not ignoring risk, but actively backing it with capital. You must also suggest treating, exposure management, and transferring, CAT XL, as part of a layered defense. 2. The conduct/prudential conflict. This is the heart of the 25-mark question. Prudential. Buy reinsurance to stay solvent. Conduct. If reinsurance makes premiums unaffordable, you are failing the consumer duty by causing foreseeable harm, uninsured households. 3. Capital management versus risk transfer. Compare the cost of rent, reinsurance premium, versus the cost of equity, holding extra capital. Holding capital reduces profitability and may make the insurer uncompetitive in a price-sensitive market. 4. Reinsurance design, CAT XL. Explain that CAT XL is specifically designed for low-frequency, high-severity weather events. It caps the loss at a certain retention level, protecting the solvency capital requirement, SCR. 5. The monitoring feedback loop. Use the actuarial control cycle to explain that the decision isn't final. You must monitor climate trends and reinsurance market pricing. If weather losses increase, the tolerate strategy must be re-evaluated. Section 3. High distinction model answer. The board's evaluation must move beyond a simple cost-benefit analysis of reinsurance and instead address the strategic tension between prudential stability and conduct outcomes. Management's proposal to tolerate the risk by holding additional capital is an economically rational alternative to expensive risk transfer, but it is only defensible if the firm has the risk capacity to absorb a 1-in-200-year event without compromising its claims-paying ability. Furthermore, capital is not free. Holding significant buffers reduces the return on equity, ROE, and may force premium increases that trigger affordability constraints for a sensitive customer base. Applying the 4 T's, I advise a blended approach. While tolerating a portion of the risk is necessary, the board should also look to treat the risk by implementing stricter exposure management, for example, limiting the concentration of policies in high flood risk postcodes. Transferring the extreme tail risk via catastrophe excess of loss, CAT XL, remains a vital prudential tool. CAT XL is specifically designed to cap severity, ensuring that a single catastrophic storm does not breach the firm's solvency capital requirement, SCR. However, the board must recognize that this introduces counterparty risk. The insurer exchanges underwriting volatility for a credit exposure to the reinsurer. This necessitates a diversified panel of highly rated reinsurers to ensure the transfer remains effective during systemic weather events. The conduct risk implications are profound. Under the consumer duty, the insurer must avoid causing foreseeable harm. If the cost of reinsurance or the capital charge for tolerating risk is fully passed to customers, it may drive premiums to unaffordable levels, widening the protection gap in a vulnerable region. The board must therefore find an optimal retention level in their reinsurance design, balancing the cost of the premium against the capital relief provided, to ensure the product remains fair value. Professional judgment suggests that a thin margin strategy supported by robust reinsurance may be more sustainable than a high capital strategy that prices the insurer out of the market. Finally, this strategy must be embedded in a continuous monitoring feedback loop. As climate change alters the frequency and severity of severe weather, the historical data used to calibrate the Cat XL layers may become obsolete. Model risk. The actuarial control cycle dictates that the board receives quarterly reports on actual versus expected weather losses and market reinsurance capacity. If the external environment deteriorates, the board must be prepared to re-specify the problem, potentially terminating certain high-risk lines or seeking innovative risk transfer solutions to protect both the firm's solvency and its long-term commitment to its customers.